There's been an increase in market volatility over the last few days as the geopolitical risk rises around the Ukraine and Russia. In the slightly longer term picture as well, market volatility has risen because as a result of fear around the prospect of higher interest rates. But what is volatility? Well, it's best seen if we bring up a chart of the VIX index on the IG platform. It's a widening of bids put in by traders for exposure to the market. Those that want to sell put in bids considerably below the market price as they want out quickly, and this causes an increase in distance between buyers and sellers, and it causes ripples, and with more market disturbance, this index rises. But what is the index, the VIX itself? It's a volatility index, sometimes referred to as the fear index. It's an index put together by the Chicago Board Options Exchange, or the CBOE, and it measures this disturbance of the markets, as I described, in the S&P 500. This widening of buyers and sellers in the market brings about good trading conditions that traders like because they can get in and out of the market quickly and profit by the swings brought about by that widening of prices. More often than not, an uptick in volatility means that the S&P 500 is falling. The speed of direction is more often than not seen as the market falls, not as it rises. A rise in the market is more often than not a relatively slow grind to a sell-off, which can be a vicious devaluation, a devaluation that causes an uptick in the VIX. So here we've got the S&P 500 going back to 1985. One of the big early disturbances that we've seen in recent generations was the 1987 Big Bang. Over a couple of months, it fell by a margin of almost 36%. The Russian Ruble devaluation crisis of 1998 saw a very quick and swift move down by a margin of 21% for the S&P 500, and another bear market very quickly. We saw a recovery and a grind higher. Then to the year 2000, where we saw the Y2K bubble unwind with a 50% reversal in the market. And then came another move up to the great financial crisis of 2007 to 2008. And around about 18 months, we saw 57% wiped off. And then came this one of the most recent rises and one of the longest bull markets in history over a period between 2008 and the COVID disturbance in 2020, where we saw 35% wiped off the market in just a matter of 2 or 3 months. And then has come this most recent bull market, taking us up to record highs. And now we've got this reversal in the S&P 500. So more often than not, an uptick in volatility means that we've got a drop in this market. Let's return to the VIX index. So you can see that by trading volatility on the VIX index, you're trading a derivative of another market rather than the market itself. Just one other feature on this index is the red dotted line that I've got down here on the index line. It's a line that some believe indicates the difference between a good trading and a poor trading environment. When the VIX is below the red dotted line, which is represented by the index at 20, the disturbance is minimal and traders don't see much distance between bids and offers. But when it rises above 20, there's an increase in trading opportunity as pricing widens. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.